Thank you, Mr. Chairman and Ranking Member Linder, other members of the committee, for the opportunity to appear before you and discuss the solvency of the unemployment insurance system. I have submitted written testimony for the record and would like to address 3 points in my remarks this morning: the magnitude of outlays and borrowing within the UI system, direct policy issues affecting solvency, and the important indirect policies affecting UI solvency, trust fund solvency as well. First, total unemployment benefit outlays have been recently and continue to be massive by any measure. $119 billion in total benefits were paid in fiscal year 2009. The Department of Labor expects that over $150 billion in benefit outlays will occur in the current fiscal year. This compares to outlays of less than $45 billion a year in each of the 5 previous years. A large share of this cost has been borne directly by the federal government, both in direct program costs of extended benefits and through loans to the states. And a large share of the total benefit outlays has also been paid by the state UI systems. As a result, as mentioned previously, and in your opening remarks, Mr. Chairman, the funding levels in those trust funds have declined significantly, and UI trust funds in 34 states and the Virgin Islands are insolvent, requiring loans totaling over $41 billion presently, and the Department of Labor expects that total loans to state UI programs may exceed $90 billion by 2013. Many state UI trust funds were poorly funded at the beginning of the recession and were not prepared to handle this heavy influx of new claims as a result of the severe recession. Because of this, the insolvency of these funds has been acute. But while inadequate reserves was an issue for many states, it is the surge in the unemployment rate and the decline in the size of the workforce that are the main culprits for the solvency crisis. Second, direct policies affecting UI trust fund balance management are important. States need to ensure a careful balance between tax levels, benefit levels, and adequate reserves. Underfunding of trust funds, as others have testified, can lead to a need to raise taxes rapidly during bad times, certainly not a wise option. However, it's important to remember that trust fund reserves can be too high, leading to unduly high labor costs and a misallocation of capital, and worker benefits can be too generous, and cause increased unemployment durations and additional economic inefficiency. And finally, the indirect policies are important as well. Fiscal policies that ensure a flexible labor market, entrepreneurship, innovation, and job creation, and adhere to fiscal discipline and constraint are critical for maintaining full employment. Unfortunately, recent efforts to stimulate the economy and create jobs have failed to meet the stated goal. When President Obama signed the stimulus bill, the administration projected it would create or save 3.5 million jobs by the end of 2010. In part by quickly implementing, quote, shovel-ready infrastructure and energy projects. These new jobs would have provided indirect but immediate assistance to state UI trust funds by reducing the number of unemployed claims and raising additional tax revenues with each new worker. Instead, federal departments and agencies tasked with spending money on infrastructure designed to fuel job creation have struggled to get the money out the door. Today, more than 2 out of every $3 allocated to the Department of Transportation remain unspent. 84% of the funds allocated to Homeland Security are unspent, 87% at DOE. Only a quarter of the money at EPA has been spent, and less than a third of DOD and Department of Housing and Urban Development stimulus funds have been spent thus far. In conclusion, healthy UI trust funds depend on good rules. Taxes and benefit levels that lead to adequate reserve building during periods of growth, but not so high as to discourage job growth or encourage unemployment. Trust funds also depend on a well-functioning labor market. Efforts to stimulate the economy have not resulted in a decline in the unemployment rate. The stimulus bill has cost more than originally projected, and the performance of the U.S. economy has been weaker than anticipated. Without effective policies to promote private sector job creation, including addressing long-term deficit woes and scheduled increases in marginal tax rates, the road to recover in the labor market may continue to be bumpy, and the solvency challenges facing UI trust funds will extend. Thank you, and I'll be happy to answer questions.